Right. So, welcome to our today's session. This is financial management, and we are going to pick it from where we left. I think I had given you a very simple question. We were looking at valuation of audience share, of course, under an ungrowing firm. Is that the state? Is that your state? Is that the state from your end? Valuation of audience share of an ungrowing firm, of an ungrowing firm. Is that the case, really? Can you just confirm? Valuation of audience share of an ungrowing firm, where we were able to look at several illustrations. I left you with one. Of the illustration. Remember what we said when you're valuing shares of an ungrowing firm. When we are valuing share of an ungrowing firm, there are some things that we consider. We consider the expected dividend. Expected dividend. And the expected dividend is the one that we discount. We discount the expected dividend using the KE, the KE at the cost of equity. So there was just a simple illustration about a certain company. And I'm happy that most of you did it and got it correct. And that is very good. That is very good. A company expects to pay a dividend of 3 shillings. So the expected dividend here was 3 shillings. A company expects solution to that question. Company expect to pay a dividend of 3 shillings. Company expect to pay a dividend of 3 shillings. Change this. Company expect to pay a dividend of 3 shillings. So expected dividend is 3 shillings. Then on its audience share, which is expected to remain constant throughout the year, we'll calculate the intrinsic value per share if the cost of equity is 14%. The cost of equity is 14%. So this is what we call D1. This is what we call KE, right? D1 and KE. So it is always good to know how we symbolize that. So to sort this, to get the intrinsic value or the PO will be equal to the D1 over KE. So simply, I'll be having 3 over 0.14. And my result will be how much? Somebody? Result yangu itakuwa ngapi? 21.43 shillings or 21.43 shillings. So my result is 21.43 shillings. That is my intrinsic value. And then we want to move to the next part, which is valuation of shares in a normal growth firm. Valuation of shares to valuation of shares in a normal growth firm. Valuation of shares in a normal growth firm. Great. Now, under this, we are going to look at what happens if we need to value share in a normal growth firm. So we shall be introducing a certain thing which we call the growth rate. We shall be having the growth here. The growth to indicate that of course, this is a normal farm which at least has some growth. So you say that in this case, right? In this case, the dividend increase. 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 Into bracket, growth of a constant rate throughout. Growth, there is dividend increase into bracket, growth of a constant rate throughout. Growth of a constant rate throughout. Growth of a constant rate throughout. There is that growth. Full stop. Next point, the intrinsic value of audience share in a normal growth farm. The intrinsic value of audience share in a normal growth farm. The intrinsic value of audience share in a normal growth farm shall be, very important, shall be the present value of expected dividend shall be the present value of expected dividend. The present value of expected dividend. The present value of expected dividend discounted using 𝐀𝐿 raise the growth rate of dividend. KE, we know the KE less the growth rate, is the growth rate. So I repeat that statement because it is important to us. We are saying that how now shall we get the intrinsic value of these normal growth farm? How shall we get the intrinsic value of these normal growth farm? We shall get it through, or the intrinsic value of audience share in a normal growth farm shall be the present value of expected dividend. If you wish, you can underline there. The present value of expected dividend discounted using the KE less the growth rate of dividend. So at this point, we shall be having the expected dividend. Expected dividend. We have the KE, or the cost of equity. We have the growth. Right? So this will symbolize as D1 KE, and this one symbolizes as G. See? KE, E1, and G. So if you want to get the intrinsic value, if you want to get the market value under normal growth farm, this one, normal growth farm, you are going to incorporate the three. Like for instance, PO is equal to, you see, expected dividend D1 over KE minus G, and you'll be done. So the item that we have introduced at a normal growth farm, it is which item? G, the growth rate, reducing our cost of capital in order to get the market value of the intrinsic value of what? Under these normal growth farm, So please have this. So where PO is the market value of the intrinsic value, D1 plus, it is the expected dividend, cost of equity is KE, and G is the right. So where PO, I just indicate that of PO is the intrinsic value. Sometimes market value. Market value. Market value, right? Intrinsic value or market. Now, I would like you to confirm whether we are together as far as that is concerned. Are we together? Are we together? Are we together? Are we together? Good. Thank you for that confirmation. Now, I want to give you another secret of how the examiner may trick you on this. Sometimes examiner, either in the previous or in this case, may come with something like this. D1 will be given by D0. Hapa uangalie vizuri. 1 plus what? Somebody who will be interacted with these things. Yes, 1 plus G. 1 plus G. So, this one represent D1. Now, what is our D0? Our D0. Our D0. It is the current what? Current dividend. Current dividend. So our D0, where D0 is the current dividend. I think that is the item that we don't have. We don't have. Now we have at least introduced it. Very important. Very important. Very important. Dividend for the current year is represented by D0. So at any given point, class note here, at any given point, examiner give you the current dividend. Current dividend. Check the dividend you've been given. Please don't use it direct here as its expected dividend. You need to convert this current dividend to expected dividend by multiplying by these 1 plus G. Sijui kama tunaelewana. Are we together? Because wakati mwingine, don't just pick it direct. Just check which dividend have I been given. Is it current dividend or the dividend for the current year, or is it expected dividend? Expected dividend is the one that you take direct to the formula like that. But if it's the current dividend, please remember to go convert. I hope that is clear to everyone. Is it clear to you? Kindly, that is important. Don't miss that point. Good. Now, let's have an illustration and see and test our understanding. Illustration. A company has just paid a dividend of 4 shillings. Yeah, this is a nice one. And I think I'll just subject you to this so that we see whether you guys have understood. It's just simple. A company has just paid a dividend of 4 shillings, which grows at a constant rate of 6% per annum. Which grows at a constant rate of 6% per annum. And the cost of equity is 10%. The cost of equity is 10%. Remember all these illustrations that we usually do from past paper, our past paper illustration, right? So this is how examiner will bring the question, right? Bring the question. A company has just paid a dividend of 4 shillings, which grows at a constant rate of 6% per annum. And the cost of equity is 10%. Is 10% required. The cost of equity is 10% required. Are we all under required? Are we all under required? It's always good to confirm this. Required, great. Calculate the market value of the shares. Calculate the market value of the share. Class, is that difficult for us? Is it difficult for us, or we can attempt? Can we attempt and give our answers? Yes, please. Can you attempt that question? So calculate the market value of the shares. So for the sake of maybe somebody who missed the question, let me repeat and make sure that you are following. Don't be distracted from your end. A company has just paid a dividend of 4 shillings, which grows at a constant rate of 6% per annum, and the cost of equity is 10%. Required, calculate the market value of the shares. Great. Great. I'm really waiting to see what guys are going to give me here. These things, once you understand, this is a very interesting topic, because once you get the concept, unless you have other issues, this is a very, very direct topic. Direct topic. This is a topic that you can grasp very fast. So can we get the answer to that? Can we get the answer to that to be very okay? That one, I'll give you time to think about it and then give me the results. And if you feel that you're not that sure, 100% sure of your answer, you just go at the back of your book and try it, and then give me the answer. The answer. I see Victor Muremi giving us 106 Kenya shillings. 106. This is very good. Remember, all of us are in different locations, and we are always genuine accountants. Integrity is at a high level, so we maintain our integrity. So whatever that you guys, you can see people or our colleagues giving there, it's independently. It's results which have been gotten independently. So who am I to deny that? Who am I to deny that? That is a clear indication that you guys have understood this. Who is having a challenge? Who is having a challenge in that? Who is having a challenge? Okay, no worries, don't worry. We are going to sort that very fast. Okay, now in this case, this question, the dividend given class, is it a current dividend or expected dividend? Hapo ndio tu unafaa kujua. Have we been given current dividend or expected? Great. You say what examiner just said. A company has just paid. Unaona you just paid. That is the catch of the question. The moment you get that, you'll be good to go. The company has just paid. You remember our formula is PO is equal to D1 over KE minus G. So what I have to do here is to come and get my D1. And how do I get my D1 now? How do I get my D1? How do I get my D1? To get my D1, it's simple. Simple because D1, I know D1 is given by D naught, 1 plus G. And my D naught is 4. 1 plus 0 point. Ni 0 point. G ni ngapi? What is our growth rate? Iko ngapi? 6%, sindio? Growth rate, 6. Yeah, 0.06. So when you grow that 4, so it will be 4 times 1.06. So can you give me the D1? Inakuwa? Somebody giving me the D1. Is it 21.2 as I'm getting from a grade 1? 4.2, 124. 4.24. 4.24. Now, once I get that, I'm able to get my PO because I know PO is given by, never forget the formula. Never forget at the start point by G. So it will be equal to 4.24 divided by KE is 0.1 minus 0.06. So what am I getting? 4.21 so 24 divided by 0.1 plus minus 0.06 ni ngapi? 0.1. No, so ni 0.04. 0.04. So when you do these calculations, when you do that calculations, how much do you get? 106 shillings. So I hope now everyone is okay. Even those people who had said that they are experiencing some challenges. I hope now we are okay. We are okay. Always check what examiner is giving you. Always check what examiner is giving you. That okay? Okay. We have another one. We have another one. Illustration number next, or number 2. The expected dividend of Laurentia Limited is 6 shillings per share. The expected dividend of Laurentia is 6 shillings per share. Full stop. The expected dividend of Laurentia, or you can put your name there, is 6 shillings per share. Full stop. The dividend growth rate is 4% per annum. 4% per annum. The growth. 4% per annum. And investors' required rate of return is 12% per annum. Investors required rate of return is 12% per annum. 12% per annum. Required. Calculate the intrinsic value per share. Calculate the intrinsic value per share. By the blink of an eye, we can be doing that. The intrinsic value, calculate the intrinsic value per share. Haya. Pata ngapi pale? Let's see who will be the first one to get this. That is Lorraine. Lorraine, she has just embraced the company, yeah? Brian, Kevin. Great. You see, this is just a simple one. Because Felix Asante, we've been told that expected dividend is 6. Therefore, to get my PO is equal to D1. Never forget formula. Ukisahau formula, mambo inakuwa noma. Minus G. And you need to write it very many times. Very many times. Very many times. Very many times. Formula, and repeat these things. These things until they are in your blood. Sawa, Annette. Yeah, don't start. Thank you. So I have 6 divided by 12 or 0.12 minus 0.04. And people are able to get that as 75 shillings. 75 shillings. Once you do that, you're going to get 75. Class, are we together? Are we together as we go to the final of ordinary share valuation? Ordinary share valuation now for a supernormal growth firm. Supernormal growth firm. Now for a supernormal, it's an interesting one and highly examinable as well. Supernormal. Are you ready for that? Are you ready for that? Julia is very ready. Rain. Saboke there. Great. Very ready for that. Very ready for Tuesday. Very ready for Tuesday. Great. Great. Now let's look at the valuation of ordinary share in a supernormal growth firm. Supernormal growth farm. Supernormal growth farm. So at this point, class, we have levels of growth. We have levels of, so the basic thing that you need to understand, it is the levels of growth. We have maybe year 1 to 2, the growth rate was 5%. Or maybe let's start with the highest, of course, the growth rate. As you start, the growth rate is high. As you continue, as the times goes by, the growth rate drop at a certain level until we get maybe to infinity. So year 1 to 2, growth rate is 12%. As we move forward, as we continue, the growth rate drop to 10%. And the final period, you find that the growth rate is going to infinity. So you say that in this case, dividends are expected to grow at a very high rate in the initial stages. Important. Dividends are expected to grow at a very high rate, in the initial stages. In the initial stages of the farm. In the initial stages of the farm. At a very high rate. You know, when you're starting something, even if it is cross country, sometimes you start at a very high speed. So in the initial stages of the farm, the dividends are expected to grow at a very high rate in the initial stages. Full stop. This is because of the high demand of the farm products. This is because of the high demand of the farm products. This is because of the high demand of the farm products. Have you written that? This is because of the high demand of the farm product. Hope you have that. Full stop. You continue and say, with time, the growth rate in dividend is expected to decline. With time. With time, the growth rate in dividend is expected to decline. Up to a point where it will stabilize. Up to a point where it will stabilize. Inateremka, like from 12 to 10. Then it goes up to a stable growth. Up to a point where it will stabilize and dividend will grow at a constant rate throughout. It will stabilize and grow at a constant rate throughout. At a constant rate throughout. NB. The intrinsic value of ordinary share in a supernormal growth farm, the intrinsic value of ordinary share in a supernormal growth farm is therefore, I repeat, the intrinsic value of the intrinsic value of owner share in a supernormal growth firm is therefore the total of a supernormal growth firm is therefore the total or the present value of expected cash flow, just raise the total, is therefore the present value of expected cash flows, the present value of expected cash flow, the present value of expected cash flow, and that present value ndio tunasema present value over expected dividend. So you can say the present value of expected cash flow, present value of expected cash flow, stroke present value of expected dividend. So hapa expected dividend ni muhimu sana. Ona expected dividend. Ona hii formula hapo. Muhimu sana hapa. Value of expected dividend. Present value of expected dividend. Present value of expected dividend, and that one we say is D1. So the moment you identify your D1, you're good to go. That is one. Number two, present value of shares. Present value of shares immediately after stabilization point. Immediately after stabilization point. Present value of shares immediately after stabilization point. So in this point, or in this case, we have the one that we had there. One that we had there. That have this. PO is equal to D1 over KE minus G. And we know that our D1 is equal to D0, 1 plus G. That is important to remember. Important to remember. Now, class, I want us to have an illustration. And this illustration, I'm going to write it down. And this is Grace Moeni Limited. Grace illustration. Let's write an illustration in this illustration. Grace Moeni Limited. Grace Moeni Limited is a private company which intends to be listed. Is a private company which is expected to be listed, is expected to be listed in the Securities Exchange. In the Securities Exchange. In the Securities Exchange. Full stop. The company has recently. The company has recently. The company has recently made a dividend issue of 3.2 shillings. Made a dividend issue of 3.2 shillings. You wish you can write the shillings before 3.2. 3.2 shillings. A dividend issue of 3.2 shillings per share. 3.2 shillings per share. 3.2 shillings per share. Per share, full stop. This dividend is expected to grow at a rate of 15% per annum. This dividend is expected to grow at a rate of 15% per annum. A rate of 15% per annum for 2 years. For 2 years. And then drop to 12% per annum, and then drop to 12% per annum, 12% per annum, then drop to 12% per annum, then drop to 12% per annum, then drop to 12% per annum for the next 3 years. For the next 3 years. 12% per annum for the next 3 years, and then drop to 12% per annum for the next 3 years. Full stop. Thereafter, comma, the dividend will grow at a rate of 6% per annum. The dividend will grow at a rate of 6% per annum. Thereafter, the dividend will grow at a rate of 6% per annum indefinitely. Rate of that percent, 6% per annum indefinitely. The required rate of return is 11%. 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 Required. The intrinsic value of the share. Great. That is where we are. That is where we are. Once you're done writing down the question, kindly confirm. Then I ask you several questions as we move forward. Are you done? Great. You guys are very fast. That's good. It's good. Now, from our question, I just want to ask you some few questions here. Some few questions. What is we have been given dividend. Is it a current dividend or an expected dividend? Somebody recently. Okay. Somebody. We have been given a dividend of 3.2. Is it a current dividend or expected dividend? Because once you identify that uko sawa. Is it a current dividend or expected dividend? Current. Thank you so much. For your answer. That is the current dividend. We have been given D0 of 3.2 shillings. D0 of 3.2 shillings. $3.2 shillings. Now, if this is the current dividend, is it possible for us to get there? Because for us, we don't need current dividend. Tunataka expected dividend so that we are able to discount that. So is it possible for you to give me the expected dividend? Please, kindly give me the expected dividend. So that we proceed. Give me the expected dividend. This is very interesting. Expected dividend, somebody is giving me that. Expected dividend, which is my D1. Na lazima uandike formula kwanza Haya, sitaandika yangu kwanza ili kwanza mmalizie. Naona Kevin ashamaliza. Kevin Abuka ashatupatia 3.68. Confirmed by Julia. That's very good. That's very good. This is confirmed. Mwanamisi. So remember, the formula is D1 is equal to D0 1 plus G. We make it grow. So it will be 3.2 times 1 point. What is our growth rate? Our growth rate will be given somewhere. Expected to grow. Where is it? Can I release it? Growth at a rate of 6%. 6%. Grow at a rate of 6%. So 0.6. Yeah. Right? Is it? Who's 15? Mwana City. Yako 15 gani? Sindio, si growth rate ni hii. Ama. Wait a minute. We have to think. Are we going to use the growth rate of we have several. We have several rates, We have several. So we need to keep on looking at our what? Now that is good. We have several, Tuko na 15 mahali. We had 15. Where did I write the 15? We have this growth for year 1 to 2. We have this growth for year up to your growth in end up to which year? For the 3 years. And then we have the last one. So we have 3 growth. Sasa, thank you for giving me the first one. The first growth, the D1 ya kwanza, that you have appreciated the fact that we have 15%. We have 15. So it is 1.0. Why am I 1.15? 1.15. This pen is not okay. Not okay. 1.15. So you guys gave me 3.68. Now this is the start point. So what for you to solve this question, then it tells you that you need at least a table. A table. So we have the year solution. Have the year. We have D1 is equal to D0 1 plus G. And then we have, at the end of the day, we have to do what? To discount using PV. So tuna discount. What is the cost of equity? Cost of equity ni ngapi? Ilikuwa ngapi? Or the required rate of return. How much? You can see it from your end clearly. Cost of equity, required rate of return. 11%. It was somewhere, the required rate of return, 11. So we shall discount using 11%, and then we get the present value, or the discounted what? Cash flow. Discounted cash flow. Good. Have this. Pata kitu kama hiyo. Mwaka D1 is equal to that PV because we are going to discount, and then twende kwa DCF. So there's something they told us. 15% will be the growth rate for how many years? 15%. 15%, just check. 15%. So tuko na mwaka 1, 2, 3, 4, 5, and 6. But our sixth year will go to infinite. I hope that is visible. 2 years. 2 years. So 15% will affect our 1, 2. 1, 2. And you guys, you've given us the dividend, the D1 for year 1. It is 3.2 times 1 plus 0.15. So you gave us a 3.68. 3.68. 3.68. Is it possible for us to get the D1 for the next year, year 2, still using the 15%? What will be the D note for year 2? What will be the D note for year 2? Sasa tumeanza vizuri. D note for year 2, somebody? Good. Now the 6.68 or the 3.68, the 3.68 is the one that will be the current for the year 2. So year 2 sasa ni 3.68. You guys are geniuses. 1.01, no, 1.15. What is this deal coming from? Now what will be our already people now got it 4.23, 4.23, 4.23. Then we move to the next one. My current for year 3 will be how much? This is now for 15% done. 15% done. I go to my third year, 4.23 is now my current times 1 point. Of course, it is 1 plus something. Itakuwa, let me put my plus so that once you are revising, what is my rate for year 3, growth rate for year 3? Year 3, growth rate, 12%. They told me very well, it will drop to 12% per annum for the next 3 years. So I expect that year 3, 4, and 5, I'll be having 12%. 12%. So plus 0.12. And then when you do that, unapata ngapi? 4.74. People are getting 4.74 to 2 decimal places, 4.74, that is what I'm getting. Is it yes, 4.74. Sasa hii ndio itakuwa current ya hii mwaka ingine. So 4.74 times 1.12 inakuwa ngapi hiyo ingine? Tumalize. Hiyo ingine itakuwa ngapi? Pata toto hapa. Pata toto pale 5.31. So 5.31 ndio itakuwa hapa times 1.12. Ukichapa hiyo inapatia ngapi? After 5.31 tunaenda wapi? 5.31, 5.94. Is that the case? You make sure that kama kuna round off una round off 5.95. And then tunabaki na hiyo ya mwisho. Hiyo ya mwisho ndio nataka tuelewane vizuri. See, the last one is the growth is 6% and going from year 6 to infinity. From year 6 to infinity. Now, there we shall introduce a very great formula here. We shall indicate a very great formula here. How do we get? We shall be having the D naught. Okay, now remember we shall be computing we want our D1. D1 tapeanwa na D naught, of course, from the previous period, 1 plus G, KE minus G. So what is my D naught as far as this period is concerned? What is my D naught? 5.95. Thank you so much. That means you shall be taking the previous year D naught when you are looking at and this is the formula for getting D1. When it comes to infinity, so we shall be having 5.95. It grows by 1.06. Divide by KE 1.11 minus 0.06, and you'll be done. Now, can somebody give me the D1? Of course, for this. Hiyo sasa ninaweza kuja niandike ka formula. Sijui nikuandikie formula hapa ama niandike the figure. Just write the whole thing. 5.95. 1 plus 0.06. That is the growth. Divide by KE 0.11 minus 0.06. Sasa usiwahi sahau hiyo, hii formula. Hii formula ni ya kupata D1 ya infinite. Andika hiyo. D1 ya infinite. Usisahau D1 ya infinite. Kindly. D1 ya infinite. That's the formula. D1 ya infinite. So mnapata ngapi? Kevin Ambuka ashatupatia 126.14 and that is being confirmed by Everine and Renette 126.14. Thank you so much. Thank you so much Renette. Asante Masi, asante kwa kuconfirm. What I want you to confirm is whether you have realized that when we are looking at the D1 for infinity, the formula is a bit special. Have you realized that? The formula is a bit unique. Kindly. So that means the end, you need to think a little bit. Right? Formula D1. Kindly. Na tunaangalia hiyo ya mwisho, una change gear kidogo. Are we all together? Okay, thank you so much. So for this case, we got 126, so 126.14. Now we can now discount. We are discounting using PVIF 11%. Kama kawaida tu, inakuwa 0 point. Use the table, use the calculator, and remember PVIF is 1 plus R raised to negative N. Enough. Aja change, not changing. So 0 point, 4 decimal places, ya kwanza, ya pili, ya tatu, ya nne, na ya mwisho. Haya. And then maybe before you continue, you see, when you're looking at the PV for this infinite, kindly note PV for this infinite. Please note. Don't even compute that. Whatever, for the previous period, you see we've used the period number 5. So we shall just drop. Whatever that we shall get as the PV for this period, for year 5, we drop. If you are having 20 years, which PV shall we drop? If you are having 20 years to infinite. No, these things ni kuangalia tu alafu inaingiana. 20 years to infinite, which PV are we going to drop? 19th year, right? 19th year, because we shall be using the current of the what? If you're having 15 years to infinite, which PV are we going to drop? Which PV are we going to drop? I want that to stick, PV 14 years. Kindly note that. So we shall not be computing PV for infinite. I have 10 years. Which PV to drop? 9. Thank you so much. Now let's move 4 decimal places. Ya kwanza, 4 decimal places, 9009. Getting 9009. Ya pili, PV ya pili. Let's finish up. 8116. Ya tatu 7312. Ya nne 7312 again. 6587. 87. Ya tano 1.1 6209. Hiyo ingine ya infinite, ya tano hapa naona kama tunagonga mwamba. Ya tano is it 62 or 59 class? Confirm. 1.11 raised to -5. -5 ni ngapi? Naona kama tunagonga mwamba pale. Haya, acha kwanza ni delete. We first of all delete that. 5935. Kevin, tutafutana gani hiyo bwana? Is it 35? Yes. 35. Now, somebody to give me that of infinite. Give me that of infinite, 6 to infinite. PV. You drop. 59, 35. 0 point. 59, 35. Always note, hizo ndizo key. The formula ya infinite na PVF ya infinite. How you're supposed to work on it. How you're supposed to work on it. Kindly ask me a question. Ask me a question. Because this one is examinable in your April exam. You're expecting something of the sort. And you get good marks hapo. Hata sita iko sawa. So, any question? Any question? Good. Seems that we are okay. Now, let's get the discounted cash flow for all this so that we get the summation. Of course, I'm confused. How? Okay, there is a question here. And don't be confused. Don't be confused, Monica. I'm confused. How have you computed PVF? Oh, PVF. Oh, PVF. PVF. Monica is among those students who did not or who joined late. So Monica and any other student, PVF formula. Monica, I want you to pick your calculator. I'll not guide you through the table right now because we may take time to maybe get the table. Kindly pardon on infinite. Okay, Kennedy, PVF rate gani? 11%, asante. Good, now we are there. Now, Monica, pick your calculator. Pick your calculator. Pick your calculator. We are using the formula PVF used to discount irregular, something that is not similar. 11% is the rate that we are using. So the formula is 1 plus R raised to negative N. That is the formula that we are using, right? I hope Monica is holding her calculator. And Monica, you are putting in your calculator, put 1.11. Of course, our 11% is 0.11, right? So put that. And then put a bracket if you wish. You can let it be in bracket, raised to -1, and tell me what you will get. This is for Monica only. Thank you so much, Lordsa, for guiding her as well. So, Monica, have you done this? Have you done this? Bracket 1.11 raised to -n. Umefanya hivyo? -n is -1. Sasa si tuko sawa basi. Si sasa uko sawa. Ukienda kwa ya pili ni mwaka ya pili, raised to -2. Ukienda kwa ya tatu, raised to -3. Monica, are we now together? Are we now together? Are we now together? Great. Now, there was somebody who was asking about the infinite. The infinite, to get the expected dividend for the infinite, kindly remember, you are looking at what we had at the previous year. That is our D naught. Because it will be the current dividend. Let it grow. And then you divide by KE, which is the cost of equity, minus the growth rate. That is the formula that you need to embrace. That is the formula that you need to embrace. Now, when it comes to getting the discounted cash flow here, you just take your growths hapa, hizi zote your D1s, you multiply by PVF. So give me the first one. 3.68 times 0.9009. Ni ngapi ya kwanza? Upate ya kwanza. Maybe to 2 decimal places. 2 decimal places sawa. Ya kwanza. 3.32. Ya pili. Like that. 4.23 times that. Ya pili. Give me ya pili. 3.43 ya tatu tuko ya tatu 3.47 ya nne. You doing well? Just taking this times this and that. 3.47 3.50 hiyo ingine ya tano 3.53 na ya mwisho 126.1 times that. Ngapi? 74.86. Now, to get the intrinsic value for that type of a bond or ordinary share, you add the summation of all these sum. You sum them. Something. Niambie unapata ngapi, so that we're done with that. It's a very nice one. Pata ngapi? Total. The total. How much? Total ya hizo ni ngapi? $92.11. 92.11. Great. Class, just look at it, think about it. Think about it. As we have a break of like 5 minutes. We have a break of like 5 minutes. So we shall be back at exactly 6:18. 6:18. Great. We have another great illustration here. Thank you for getting it correct here. It's correct. We have another illustration, and I want you to write it. Pole pole. You say that we have Amos Limited. Amos Limited generated 50 million shillings profit after tax. Amos Limited generated 50 million shillings profit after tax. Generated 50 million shillings profit after tax. Amos Limited generated 50 million shillings profit after tax. 50 million shillings profit after tax. In the previous financial year. In the previous financial year. In the previous financial year. Full stop. Full stop. In the previous financial year. Full stop. Next, the firm adopts 40% payout ratio as its dividend policy. The firm adopts 40% payout ratio as its policy. 40% payout ratio as its policy. As its dividend policy, sorry. There is dividend here. As its dividend policy. As its dividend policy. Full stop. The total number of issued ordinary shares are 10 million. The total number of ordinary shares are 10 million. The total number of ordinary shares are 10 million. Total number of ordinary shares are 10 million. Full stop. The company has a potential investment opportunity. The company has a potential investment opportunity. A potential investment opportunity. The company has potential investment opportunity. The company has a potential investment opportunity. The company has a potential investment opportunity. Full stop. If that opportunity is undertaken or investment is undertaken, if undertaken, the dividends are expected to grow at a rate of 10% each year. The dividends are expected to grow at a rate of 10% each year. Grow at a rate of 10% each year for the first 3 years. For the first 3 years. For the first 3 years. And then stabilize at the rate of 5%, and then stabilize at a rate of 5%, stabilize at a rate of 5%, a rate of 5% each year thereafter into perpetuity. 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 Full stop. Full stop. The investor's minimum required rate of return is 18%. The investor's minimum required rate of return is 18%. Required rate of return is 18%. Determine the current intrinsic value of the share. Question is, determine the current intrinsic value of the share. Intrinsic value of the share. Determine the current intrinsic value of the shares. 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 That is the question. That is the question. That is the question. Are we together by writing down the question? Are we together? Have we written? Have we written the question? Kennedy, yes. Edward, yes. Asante. Great. Now, how now do we solve this question? How do we solve this question? See, at least now examiner started bringing several terms, payout ratio, dividend payout ratio 40%. Now, how do we get our expected dividend? Because that is what we need. Or how do we get either the current dividend? How do we get the current dividend? Who can guide us? It is simple, by the way, not something that is so complex. It's simple. How do we get the current dividend? We need the current dividend so that we are able now to start working on the current dividend. How do we get the current dividend? Somebody. So if you've been told that the shares, number of shares is 10 million, number of shares we have 10 million, and the dividend payout ratio is here, and these guys had a profit of 50 million. See, we are able to get the current dividend class. If our profit after tax is 50 million, and we have the dividend payout ratio, we know the retained earning that this company can have, dividend paid over ordinary share. Okay, good. So in this case, how do we get the dividend per share? People are just trying to give us the hint of how we can arrive to that. Because once we have our D note, we are good to go. We are good to go. D note. D note. So our current dividend, how are we going to get that? What is the total dividend paid? What is the total dividend paid? Total dividend paid 20 million. 20 million. 40% of? Is it 40% of 10 or 50 or how much? 20M, we have agreed that the total dividend paid is 20 million. You see, from our question, we have the profit, whatever that is earned, and the dividend payout ratio is 40%. What is 40% of 50 million? 40% dividend paid is equal to 40% of 50 million. Inakuwa ngapi? How much? 20, right? Sindio? 20 million. That is the dividend paid. If this is the dividend paid class, if that is the dividend paid, and we had the ordinary number of ordinary shares 10 million, is it possible for us to get dividend per share? Dividend per share, because that is the one that we want. That will be our D note. It will be used as our D note. Is it possible for us to get that? Yes, because we already have the dividend that was paid, and then we have our what? We have the dividend and we have our what? Number of shares. So total dividend, thank you so much. Total dividend, hatutaki we make it complex, divide by the number of shares. Like that. So it will be equal to 20 over 10. So what is our 2 shillings? 2 shillings. We are done. Now, class, with the 2 shillings, is it possible for us now to start working, to start growing these 2 shillings? Growing like that. Yeah, it's very possible. So we have the number of years. Now, for the first 3 years, it's growing at 10%. So come here, put your ear. Hope it's visible. Yeah, just a bit. You put your ear here. Your D1 is equal to D naught, 1 plus G, PVIF. What is our rate? Our rate is, wametuambia tumia 18%. And then you get your discounted cash flow. Of course, discounted cash flow like that. Then, year 1, 2, 3, inafika ngapi miaka yetu? Each thereafter. Inastabilizia tu hapo. So from year 4 to infinite. Year 4 ndio inaenda to infinite. Are we together? These are the order. This is the order from your end. That's the order. Yes. Now we start growing this 2 times. We are growing it. Hiyo ni our D. 1 plus G. 1 plus G. What is my first G? My first G ni 10%. So 1.1. 1.1. Inakuwa ngapi? So let's grow our 2. Let's grow our 2. 2.2. 2.2. Let's grow our 2.2. Still, for the 3 years, inaenda na 10%. 10% for the 3 years. 1.1. Let's grow our 2. So it is 2.42 again. So it is 2.42. Okay, 2.42. Let's grow our 2.42 times 1.1. 1.1. Nakuwa 2.66. Now I want somebody just to give me the D1 for the infinite. Kindly. Aya, tunagoja sasa. D1 for the infinite ni ngapi? D1 for the infinite ni ngapi? Sasa hapo ndio tunataka kutest waters. Simple. Ka formula pale. Anza. Gatili Rispal Gaki giving us 21.50. 21.50. We shall confirm. Let's wait, but if Gatili got it correct, that means her speed is okay. Her accuracy is okay. That is what we call South Africa. She has already decided to fly to South Africa. Kevin giving us 21.4851. This is very nice. Remember, our formula is if I want to get these d1 for infinite is equal to d naught, I grow it plus g divided by ke minus g, and it will be simple for me to come and put my d naught, which is this one. Usisahau for the previous 2.66, 1 point, growth rate is 5%, 0.5, divided by KE is 18, 0.18, minus 0.05. You guys are great guys, and that will give us 21 points. Class, are we together really? This is very good. So I come here and put my 21.50, 21.50. 16.87 ni gani? 16.87 ni gani? Where? Grace, can you check? Check here. Ka formula tu kwanza. Sawa. So that is it, class. That is it. Is it possible for us now to discount 0 point? In fact, now it will be easier for me. Give me the first one. 1.18 raised to negative 1. Ni ngapi? Grace, I hope now we are together. Weni, I hope we are together. You just use the formula. Formula muhimu. So give me the first one, 84.75. Hiyo ingine, mwalimu, I got kicked out. I didn't get the first part. 𝐀𝐿𝐴 was kicked out. The first part. We have said that if you want to get the DPS or our D naught is for you to first of all come and get the dividend paid. And we'll be told that the dividend paid or payout ratio is 40%. So it's going to look at 40% of what? Of 50. Great Mweni, asante. 40% of 50, we got 20 million. This 20 million, it is the dividend paid or the total dividend paid, right? If you now want to get the D naught or the current dividend, it is for you to take the total dividend divided by the number of shares. And the number of shares we have been given 10 million. So it's 20 divided by 10. That's why we got 2. Once you get 2, you now use the 2 to get the D1. Are we together? 𝐀𝐿𝐴. Thank you. All right. Now, from this point, we are getting the PV. So get the PV for year 2, 71.82. The other one. Hiyo ingine ya tatu. Ya tatu tunapata ngapi? 86. And the last one, you drop. Like that. You drop. So give me now the final DCF. DCF ya kwanza ni ngapi? Somebody 2 decimal places sawa. Be using that. 1.86. Ya pili, let's do it very fast. I want you to give a question, then we analyze how far you are. Remember, today is 25th. What we agreed? We agreed something that today we are going to analyze how far we are as far as the group discussion is concerned, as far as the theory topics are concerned. 1.62. And the last one? The last one ni ngapi? Ya mwisho. Itakuwa mingi kidogo, sababu hii ni mingi kidogo. 13.07. So what is the intrinsic value, class? You add the 4. The intrinsic value, you add the 4. Add the 4. Inakuwa ngapi? Total itakuwa ngapi sasa? 18.29. 18.29. Asante. That is the intrinsic value. Assignment. Linet Limited is forecasting a growth rate of 12% per annum. Linet Limited is forecasting a growth rate of 12%, 12% per annum. A growth rate of 12% per annum. Linet Limited is forecasting a growth rate of 12% per annum for the next 2 years. For the next 2 years. So 12% per annum for the next 2 years. Full stop. Full stop. The growth rate is likely to fall to 10% for the third and the fourth year. So the growth rate will fall to 10% for the third and fourth year. The growth rate is likely to fall for the third and the fourth year. And the fourth year. Full stop. Full stop. After that, the growth rate is expected to stabilize at 8% per annum. Is expected to stabilize at 8% per annum. At 8% per annum. Full stop. The company has just paid dividend of 1.5. Oh, katiri tunarudia wapi? Tunarudia wapi? Tunarudia wapi? After that, the growth rate is expected to stabilize at 8% per annum. 8% per annum. To stabilize at 8% per annum. Don't worry. I just proceed. I'll repeat it. The company has just paid a dividend of 1.5 shillings. 1.5. The company has just paid a dividend of 1.5 shillings per share. 1.5 shillings per share, and the required investor required rate of return is 16%. Required rate of return. Rate of return is 16% per annum. Per annum, 16% per annum. Required, the intrinsic value of the share. Sometimes the examiner may ask you the minimum, the highest. Remember, all these things wanataka upate nini? The value of share. The intrinsic value of the share, the intrinsic value of the share. Kuna mtu yeyote amepata yote, amepata hiyo swali lote? Anybody who is able to, or who has been able to get the whole of that question? Annette got it. Julia amepotea kidogo. Ni vizuri hata Julia ukipotea usiseme ni sana. Hey, I'm lost. Si sana. I'm lost. Usiseme umepotea yote. Sema at least umepotea kidogo. Okay, Annette got it. Okay. Anybody else who got it? I'm going to repeat. I'm going to repeat before we do the analysis of what we said. Anybody who got it? Anybody else who got it correct? Yote? Vizuri? So the question is, Salfin got it. Ilikuwa Linet Limited is forecasting a growth rate of 12% per annum. For those people who got it, you can take a picture, share in the group so that tusaidiane. Forecasting a growth rate of 12% per annum. Your 12% per annum. For the next 2 years, For the next 2 years, full stop. The growth rate is likely to fall to 10%, 10% for year 3 and year 4, for year 3 and year 4, for the third and the fourth year, full stop. After that, the growth rate is expected to stabilize at 8% per annum. It is expected to stabilize at 8% per annum. You see, it is stabilizing at 8% per annum. The company has just paid a dividend of 1.5 shillings per share, and the investors' required rate of return is 16%. The investors' required rate of return is 16% per annum required, the intrinsic value per share. Are we now together? Are we now together? Are we now together? Are we now together? Kwa pamoja sasa. Kwa pamoja sasa. We now together. Great. Now, class, as we had said, when we were starting the semester, we said that we are going to discuss or to review how far we are as far as topic 1, 2, 3 notes are concerned. Remember, we shared the notes, topic 1, 2, 3. So that question, the question that I've given you, please try and do it in your group discussion. In your group discussion, kindly. So you agree, yeah? You agree? You do that question. So topic 1, 2, and 3. The notes, at least you have the notes. You have the notes with you. Now we want to know how far are you as far as this is concerned. I think, okay, it's okay. How far are you? How far are you? How many people are done? How many people are done with topic 1, 2, 3 summary? Remember, it's just a summary. Tulisema mara ya kwanza soma kama gazeti, right? Mara ya kwanza unasoma hizo note kama nini? Gazeti. Mara ya pili sasa pitia ukiweka nini? Your short notes. Short notes kidogo kidogo, right? And then mara ya tatu hiyo kitu shaingia kwa damu. So I want to know the number of people who are done up to topic 3 summary. Where have the notes been posted? Kindly share. It will be shared. I'm not yet started. Yeah. Okay. Kindly share the notes. This is my first question. Okay, sawa. We are taking Lynette. I hope you are taking note with Omondi. I hope you are taking notes. Now I'm asking the second time. How many have finished up to note 3, topic 3, making some short notes? How many? Not started. Why? Yeah. Oh. Oh, Annette, you're done, right? So far we have 1. So all we have 1. At topic 2, kwa topic 2 tutafika. So thank you, Francisca. Okay. Topic 1, Edward. Oh, Edward. We have another one. Topic 3. Tulikuwa tumepeana hiyo period ya kumaliza. Nyinyi watu. That was the period to finish up the 3. Have lost. Have lost network. Please pardon the assignment. Assignment. Somebody to just take a picture of the question and share. That is the assignment. Please, this is my second class, but I don't able to access LMS for the previous classes. You be guided. Monacity done all the topics. Great. So we have like whatever. How the printouts must I rewrite the notes again? You know, let me tell you, 𝐀𝐟𝐿𝐴, the moment you are trying now to translate from there, the write-up that you have, the printout, right? And then putting it down to your book as a summary, it helps you to understand more. So we have different types of people. There are those now who understand akisoma tu ni hivo. So if you are that kind, it's okay. Someone to share, it will be shared. Assignment, somebody to just take a picture and share. So we have like, we say, we have several of you who have done up to topic number 3. A challenge to anyone. Remember, today was the deadline, so that I share the others. Today was the deadline for all of us to have done what? Have done the 3. But for the sake of even those people who have just joined recently, the notes will be reshared. They're not big. They're not huge. It's not something bulk. No. It's something that if you dedicate your 2 hours, unamaliza moja. Another 2 hours or 3 hours, another one, like that. So if you have like one day vizuri, what about the forming of groups? Wait a minute, we are coming to that. So for the notes, kindly, for creating the short notes, kindly make sure that by next week, by next week, everyone is done. So that by Wednesday, when we are having our next class, we shall share the rest of the notes, right? Is that a deal? Is that a deal? So next week by Wednesday, kindly. Wednesday ni date ngapi? 29 ama 29, si ndio? 29th. Kindly, wacha tuzivuke na hiyo nini? February. February iko na mambo mingi, eh? February iko na ni fupi. February ni fupi na iko na mambo mingi. So kindly, 29. By 29, let's all of us are clear. Let's all of us clear. But now, what do we do to those students who have already cleared? Who have already cleared? So let this be the deadline for everyone to clear topic 1, 2, 3. And maybe start what I'll share today. Allow me to share the others today. So that for those people who have already cleared, we cannot drag them behind and they have already cleared. We will not be doing fair to them. Sio ni ukweli? So we share the other topics today. I'll share today. So that those people who have already finished the 3, they can continue. They can continue. Hakuna kuvuta watu nyuma. Ni kusonga kusonga. So can you work hard so that by Wednesday everyone atakuwa amemaliza, and then tujipee hadi the end of what? The end of February kumaliza the others. Hata February itakuwa mbali sana. Maybe you can say no, it's okay. It's okay. End of Feb tukue tumemalizana na hizo zingine. End Feb. Tukue tumemalizana na hizo zingine. So hiyo ni another 1 month vizuri. So weekend kama assignment haiko, you are going to the notes. Are we together? If you have not been given assignment, you go to the note. You write down some short notes like that, try to understand. Once tutafika kule, itakuwa easier because at least you'll be having the concept with you. About the creation of the group. How many groups are fully created and operating? How many groups are fully? Ni group gani? Group yenu, is it fully created and operating? Unajua sometimes it can be created but not operating. It is dormant, which is very bad and dangerous. It is dangerous. Your group, once your group is ready, kindly, our group is created and on. This is very good. So we have Lynette's group, and that is commendable. Yeah, so we have one group which is created and operating. So the question that I've shared, kindly, we'll discuss as a group. I want you to discuss that question as a group. I don't know the group I am. So Lynette, just Kemboi, if you don't have a group, kindly, can you drop your number there? You can be added to the group with the rest number of people. You drop your number there, kindly. Tunataka tumalizane na hii stuff as early as now. Sawa. Any other group that is fully complete and operating? Do we have any other? Mko sawa, msha form na mmeweza kucommunicate pale. Kupangana. Saturday saa 8 tunapatana masaa mawili. Up to 4. We do 1, 2, 3 like that. Any other group? Tulisema once the group is complete, select a group leader. Mwenye atakuwa akiwa lead. Naambia today, let's look at this question. Let's challenge ourselves today with this past paper. See, group 3 on and operating. This is good. So, Lynette, I hope the class rep, I hope you guys, you are taking the group 2 created as well. Some members you're yet to join. Created. Now, can you make sure if at least you have a group with several members, Several members. Sasa si unaona kuna members hapa siuchukue hata umuongeze. Sichukue hata umuongeze. But to make sure that there is order, let the class rep pick the numbers and then we'll distribute in the WhatsApp group. Kindly to you communicate so that at least our groups should start operating as early as now. In fact, this weekend, I expected that those groups should discuss the question that I've given. the groups. You discuss it as a group. You discuss it as a group. That one, I don't want you to share individual answer. Yeah, you communicate. You talk about the groups in there. WhatsApp. You complete that thing. See, tufunge hiyo agenda ya group this weekend. And inform those people who are not here. Let them know that during the weekend, we are completing everything. Haven't seen any activity. Where we? Group 1, Lynette. Which is your group? Is it group 1? Okay. So mtapangana. Let the group be very active. For group, ulizeni maswali, challenge each other. We shall be reviewing the group progress every Friday. Group progress tutakuwa tukireview every Friday. But for the notes, the one that I'm going to share, we shall review at the end, our February end lesson. The lesson that we do at the end of February, the notes. So kindly make sure that at least you are doing something. Don't just stay like that. Do something. Hii time si kubwa, sio mrefu. Kuna time inafika sasa mambo inakuwa moto. So it's up to you kujipanga sahi mapema ndio best. And that is it. Unless there's a question, I encourage you to organize your house, your room, your house for the group discussion and make sure that it's operational. If it's dormant, kindly raise up and make it operational. Using the RMS WhatsApp invite link for group. Group to me. You create groups. The group leader will create a group leader. Somebody you can also create and then invite your members. I know FM several groups are complete already. Kitu imekosa sasa ni the group WhatsApp group. So can you volunteer as a group leader? Create a WhatsApp group. Invite your members. Tell them this is group 3. Members to join. You share the link. That will be well. So by Monday, wacha sisi sote tukuwe na group and it should be functioning. That is it. Any question as we wind our session? Any question? Want us to end our session? Kuna swali lolote? Anyone with a question? All right. So if there is no any question, thank you so much for having time to attend our today's session. It is a great sacrifice to wake up very early in the morning. I know you did not wake up at exactly 5. You woke up some minutes to 5, or even 4. And that is a great sacrifice, and it will yield some great and sweet fruits at the end. So continue working hard. Remember, this is a sacrifice you are making once and for all. Usifanye alafu uifike mahali uchoke and then ukute unarudi tena. It's not good. So let's just work. Be very aggressive in that group. Be very aggressive until we do our exam. Otherwise, that is it for today. Thank you for your time. Let's meet next time. May you have a blessed weekend and a blessed day. Goodbye. I've been your lecturer, Stephen, always inspiring growth. Asante. Thank you. Good day too. Asante. Goodbye.